There was a landmark study that was done in 1991 that concluded that asset allocation explained the majority of the variation of portfolio returns. That very little had to do with security selection, that's stock picking, or market timing. So what we mean by this is the most important decision that you can make for your portfolio based on your risk tolerance, your time horizon, and your goals and objectives, and those matter more than anything else, is what percentage of your assets should be invested in these 5 broad categories. And those are stocks or equities, bonds or fixed income, real estate, cash, and ultra short-term fixed income, or alternative investments or other, which is kind of a broad category of investments that don't tend to move as much with stocks and bonds and real estate. So that's things like private equity, private debt, private investments, commodities, lower correlated assets. The most important decision that you can make is what percentage of your overall assets should go into these 5 categories. The next decision is within each of these categories, what are the sub-asset classes that we should invest in? So within stocks, we tend to see a lot of stock portfolios that come to us that are invested heavily in U.S. large cap stocks, because those are just the names people have heard of. But in fact, small caps over long periods of time have tended to outperform. You need to have diversification internationally. So within stocks, how much should you have in large cap stocks, small cap stocks, mid cap stocks, international stocks, emerging market stocks? And then the third decision is, what do you buy for large cap growth? What do you buy for large cap value, for example? So you could buy a basket of large cap stocks, which we recommend for most investors not to do, because you don't need to take that risk of those individual stocks. You could buy a mutual fund and give your money to a manager to pick stocks for you. We recommend against that. Or you can buy the index, which is what we recommend for that category. So a large cap growth index or a low cost way to purchase these different categories. But it's a multi-step process. It should not start with, I like this company, so I'm going to put all my money in it. It starts with a plan, and that is based on your goals and objectives, and those answers need to be different for everybody. So when we talk about diversification, you could be in a portfolio of 20 stocks that all are similar, and you're not really going to be that diversified. The way to diversify is you want to diversify across the asset classes that we talked about, the categories. Then you want to diversify geographically in the United States and internationally. You want to diversify through capitalizations, have small cap, mid cap, and large cap. You also want to diversify between styles of investing, growth and value. And what those are is growth stocks are companies that generally are growing faster. They're putting the money back into the company to continue to grow. They tend to trade at a higher multiple. Value stocks are companies that may pay a dividend. They trade at a lower multiple and are considered to have more value. So why is it important to have diversification in all of these ways? So let's look at U.S. versus foreign stocks. If you look at this chart, the purple shows international stocks, periods of time when international stocks outperform the U.S. The gray shows the periods of time when the U.S. outperform international. And just as we always say, investors tend to want to buy high, right? You have people that will look at the last 15 years and say, why would I want to diversify internationally? The U.S. has done so much better. Well, that doesn't mean that it always will. So if you look at this, there are long cycles when one does better than the other. If you own both, you are protecting yourself from that extra volatility and that extra risk. Same thing with growth and value. The light green is growth. The dark green is value. You have multiple years when one does better than the other. In the long run, value has tended to outperform, but we do recommend having an allocation with both, potentially with a little bit of a tilt towards value. So this is a risk reward chart. And ideally, we always say with this chart, you want to go up and to the left when you can. Things don't really work that way, but you want to ideally go up to get higher returns and left to have lower volatility or risk. So on the bottom right in the orange, this is a 100% bond portfolio. If you had added about 1/3 in stocks to that portfolio, so now you're adding something that is more volatile and more risky, you would have kicked up your returns because stocks have done better than bonds over almost every long period of time. But what surprises a lot of people is even though you added a more volatile, more aggressive investment, you actually reduced the overall volatility of your portfolio. So why is that? How could you take something that's more aggressive and actually reduce your volatility? And the reason is correlation. These bonds are all moving up and down together, primarily with interest rate movements. Stocks move differently. So if you add a component in stocks to this all bond portfolio, you will actually end up with a portfolio that has slightly lower volatility. Now, this up and to the left doesn't always continue to happen. Ultimately, it really is the more risk you take, the more return potential you have. But the idea is that true diversification, when you're diversified across asset classes, and when you're diversified within those asset classes into different types of stocks and different types of bonds, you can gain either higher returns for a similar level of risk or lower risk for a similar level of return. That's the beauty of asset allocation done right. This chart also will tell you why even the most conservative investors, meaning people who are putting money away for the long run, money that they're not going to tap into for a period of time. So this will show you why even the most conservative investors should have some stocks, but also it'll show you why even the most aggressive investors should have some bonds. Because look at the other side of this. This purple is the all stock portfolio. If you had added 20% in bonds to it, you would have reduced your risk substantially, but not taken too much away from your returns. We hope you found this to be helpful and enlightening. For more information, please feel free to take a look at our website at www.aireadvisors.com. Thank you and happy investing.